So the question is, what's the bid for duration out there? And the
Right.
biggest surprise, one of my biggest surprises that I look at, because I never know how large the duration bid is how large that bid is. Over the years, I've seen all these panic situations. The Fed's going to do QT, sell long bonds. This is going to happen. That the long bond sells off, and that's it's like this is going to get up to 10%. They're not going to be able to sell it. They're going to have failed auctions. And all of a sudden, it rallies like 100 basis points, and it's like lower than it was before because of that bid for duration. So where is that coming from?
Welcome, everyone. Today, I'm thrilled to introduce Warren Mosler, an economist and financial professional, widely recognized as the originator of modern monetary theory, MMT. In 1982, he founded the investment company Illinois Income Investors, which held the top global ranking through 1997 for fixed income managers. And drawing on decades of market experience, Warren developed MMT in the early 1990s, offering groundbreaking insights into how modern monetary systems truly function. Now based in St. Croix in the US Virgin Islands, he runs Valence Company, Inc., and continues to shape economic policy debates. He's best known for Mosler's Law, which holds that no financial crisis is too deep for a sufficient fiscal response. His notable book, The 7 Deadly Innocent Frauds of Economic Policy, has been translated into multiple languages, and his contributions earned him an honorary doctorate from Franklin University, Switzerland. Warren, thank you so much for coming on the show.
Welcome, Digger. Thank you for that introduction.
It's great. Actually, I was remembering when the idea for having you come on the show first took hold. I was sitting at a table with PJ Pierre here in Cayman at an event.
Okay.
And Jason Buck mentioned that PJ had studied under you for some time. And I completely commandeered his evening, I think, just pounding him with questions. And so hopefully he had some fun. We spent quite a bit more time together after that discussing similar topics. But anyways, that's how this came about.
Okay, very good. Yeah.
I also wanted to say Richard Latterman, portfolio manager at Resolve, is also on. He requested to be on, as he often does, with guests who are offering insights on policy or economics, et cetera. So let's get into it, Warren. For those who have not been studying the evolution of economics and economic policy over the last decade or so, maybe can you provide ground zero on what modern monetary theory is and maybe how it departs from what many would think of as classical economics?
Okay, so what I find is that much of classical economics is in the context of a gold standard or some fixed exchange rate policy, which we don't have today. So you might look at it like this translation of economics from fixed exchange rates, floating exchange rates, or from my own point of view, a ground up study of floating exchange rate context for economics as opposed to fixed exchange rates. Okay, so you are all have traded some foreign exchange. Yeah, so you know that if you take a currency like the Hong Kong dollar, which is fixed exchange, fixed to the dollar, and you sell the forwards in size, the spot is fixed. As the forwards drop, that's the 90-day rate. It's the same thing. And you're actually driving up interest rates. And that was the old trade when I first started. An equity hedge fund would get short stocks in the Hong Kong market and then sell forwards in the currency to drive up interest rates, which would spook the stock market. It would go down, they'd cover the short, make a little money, and then hope that it was back covering their position in the Hong Kong dollar. It worked very successfully. There was good leverage, between those two in terms of the percentages they had to move to make it work. Okay, now if you try to do the same thing with the yen, which is floating exchange rate versus the dollar, you sell forwards, you can drive the currency down, but the rate is going to stay at zero if that's where the Japanese rate is fixed, and the spot forward are going to stay the same. So there's something very different going on with those two currencies. And so we've seen like fixed exchange rate currencies blow up all the time. I remember the Mexican peso in 1994, the ruble in 1998, and the ERM system that blew up with the pound. But you never see that with floating exchange rates. So there's something very different going on. You'll see the currencies go up and down. We saw the euro depreciate 50%. Nobody really noticed. We saw the Australian dollar depreciate 50%. Nobody noticed. So we've seen them go up the same amount, sort of make second page or third page news. So it's very different. And so I think that distinction is something that modern monetary theory, that I recognized back in the early 1990s, and before it was called modern monetary theory. And it later came to be called modern monetary theory because most of today's currencies are now floating exchange rates.
Okay, so I actually didn't know that. I didn't realize that the root motivation for rethinking economics was that it's sort of implicit in neoclassical theory, for example. Most of neoclassical theory I'm hearing from you is generally under the assumption of a fixed exchange rate regime.
Yeah. I want to tell you how bad it is. Okay, you've seen all the talk now about the neutral rate, the Fed just trying to figure out where it is and whatnot. Well, where'd they get that idea that there is a neutral rate? Okay, they didn't get it from floating exchange rates. That's an echo from fixed exchange rates. Under fixed exchange rates, like I just talked about, the Hong Kong dollar, for example, the forwards are set by the market to reflect an interest rate, which is the indifference level between where somebody's willing to hold Hong Kong dollars versus cash them in and get US dollars at the monetary authority, right? Not a simple gold standard where you have convertible currency and the government wants to deficit spend. It's adding gold dollars, right? And it has to then borrow those, right? And when it does that, why is it doing that? Okay, so what it doesn't want is people with the gold certificates to cash in the gold and deplete the gold reserves. And there's an interest rate at which the investors whoever's holding whether they're convertible reserve balances or actual convertible currency, is indifferent between holding that currency and cashing it in for gold. And you get a positive yield curve because the longer the maturity you buy, the longer you have to wait before you can get your gold, and the more odds are something's going to go wrong. So if you looked at the Russian ruble, I don't know if you were around for that crisis in '98, but Russia, that was convertible to dollars at 645 to 1. And there was some concern as to whether if you had rubles, you could get dollars. It was certainly overvalued in terms of any other reason you'd want to hold them other than eventually to convert them. And so you saw that risk being expressed as interest rates went up. The Russian government was selling GKOs to keep people from cashing in their rubles for dollars. And you saw the rate go to 5%, 10%, 20%, 40%. And then they'd borrow a few billion from the IMF. Okay, people felt that they had a little bit of a window and go down to 20%. And then when the IMF loans were exhausted and cut off, it's okay, now it goes up to 50%, 100%. And it was up to 200%. And it still wasn't enough for anybody to hold that thing rather than convert to dollars. And interestingly, the central bank, I think they didn't even turn the lights off. I think they just all got up and left, depart back to their desks for about 3 months. And so there was no, but because they didn't know what to do. They didn't know how to float the currency, or they didn't think to do it, or didn't want to do it, or they're afraid they're going to get shot. I don't know. It's a different kind of place. But anyway, so to the point, which I've sort of skipped my mind of your original question.
Yeah, I was just saying I didn't realize that the motivation was fixed versus floating exchange rates.
Yeah. So okay. So anyway, so that was a situation that I can't remember what I started to say on that. Do you remember?
Maybe we can. I'd like to unpack this idea of the departure from classical economics that MMT takes, and maybe unpack this idea a little bit further by maybe going into the order of operations, right? I think Stephanie Kelton in her book put it as STAB, versus tabs, right? Spend before taxing and borrowing, whereas classical
so
economics
let's start from the beginning. So the dollars to pay taxes come from the U.S. government. That's that's not in any of your models. You have G minus T where you have to collect taxes to be able to spend. They don't put the causation the right way. The formula is okay, but the G has to come first before the dollars are there to pay taxes. And if you talk to anybody in the Fed, they go, yeah, of course, we can't do a reserve ad without a prior reserve drain. And their job is offsetting operating factors to make sure that when Treasury securities settle, there's and they see Fed funds going up, indicating the reserve balances are short. They come in and do repo, they add reserves. Now, with QE, it's a big reserve ad in advance, so they don't have to do it every time there's an auction or whatnot. But even on fixed exchange rates, they're still spending first before they're collecting taxes. So what they do is they buy the gold first. Print, you might say, gold certificates or credit accounts that are convertible accounts at the central bank first, and then those dollars are there to pay taxes. So it's simple analogy. I mean, nobody thinks a football stadium has to collect the ticket first and then sell it. Everybody knows they sell the ticket first and then collect it because that's where it comes from the stadium. Now, President Obama made a statement once that that the money comes from the government. He got shouted down. He said, no, real wealth comes from the private sector. So what they did was they conflated or something real wealth with the money to dollars to pay taxes, right? And he agreed that real wealth came from the private sector. The government takes some of it. And so he backed off on his statement. He was correct. The dollars to pay taxes, the tax credits needed to comply with tax liabilities come from the private sector. And that's what Stephanie's talking about with the sequence. And every congressman has that sequence backwards, at least I think everyone does. They all think they have to get dollars by taxing what they don't get by taxing. If they want to spend more than that, they have to borrow it. They're borrowing it from China and worried about leaving the debt to the grandchildren and all that kind of thing. And you saw the Obama administration, they wanted to do that stimulus. Number one, they did half what they thought they needed because they were afraid of borrowing $2 trillion instead of $1 trillion. Secretary Clinton flew with Obama, I believe, to China to talk to our bankers to make sure they would buy our bonds so that we could make sure our healthcare system wouldn't fail or whatever it was. And Paul Ryan was there saying we're going to be the next Greece. He was a head of the Republican Party, Speaker of the House. If we'd be on our knees at the IMF, if we ever tried to borrow this much money. And I think Paul Krugman had a big document in front of the president about how interest rates would go up. If it wasn't Paul, it was somebody else like that, another New Keynesian. And now we look 8 years later, and we have a COVID, maybe total deficit spending, maybe $5 trillion, I don't know. Not a word of Greece. Nobody was worried about China. Nobody worried about rates spiking. All they worried about was whether or not it would cause inflation. Now, where did that come from? What changed in those 8 years? And I think that was, the poster child was Stephanie Kelton when she got the job at the Senate Budget Committee. People started looking into it. She started talking about it. They started reading on it. And suddenly, but over those 8 years, it became understood that government checks weren't going to bounce. They might not have exactly understood the whole thing, but they knew the checks wouldn't bounce. Rates wouldn't spike unless the Federal Reserve voted higher rates. And that the issue would be inflation, whether they were spending too much and driving up prices. And they're still arguing about whether they spent too much and drove up prices or not. Nobody's arguing about whether or not the check was going to bounce. So I'd say MMT changed that, dialogue for the better. Because the argument is what are the ramifications of the spending, not are the checks going to bounce. The government spends first, and then the securities are sold. They don't have to worry about whether or not the securities will be sold. And go ahead.
What do you think causes the consternation and or cognitive dissonance that seems to be so prevalent among, as you mentioned, congressmen, but you also mentioned a variety of fairly well-known mainstream economists, policymakers, et cetera. Why do you think this is so difficult to comprehend or to internalize?
That's a good question. I was hoping you could help me with that. I find it painfully simple that any 10-year-old can understand it. I've talked to people who are now in Congress or in Congress, like Senator Blumenthal, when I was running for Senate when he was running, and I didn't win. I got 1% of the vote, but I met with him for about 3 hours at a friend of mine's house in Darien up there, and he said, "Yeah, this is how they taught us in Harvard back in the '60s," but he wouldn't go there. And then later, I met with him once after he got in and said, "Well, is there anybody else in Congress who understands this?" I said, "No." He says, "Well, if there is, let me know, and then I'll start talking about it too." So I know him. He personally just didn't want to take the first step. I can't say too much about the others because I don't have the personal contact. There's Van Hollings, is that his name, in Virginia, congressman. He understood it. I was up there with a friend of mine and had my book. He'd read it, went through it, and same thing. He was waiting for somebody else. So I guess it's a level of intellectual dishonesty at that point, but at the same time, it's a lack of, political will to go there. And path of least resistance is to get reelected, to get funded, is to keep saying what they're saying. So it's just tough for me to give you a definitive answer for that question.
Do you think that do you think that once you open the door on a conversation about the fact that government spending is not constrained by income taxes or by the ability of the government to exogenally fund itself,
right,
that people fear that it will remove the scarcity constraint or the scarcity mindset?
Yes. Yes. Yeah, definitely. And there's a couple of things on that, and I say, look, either you believe in an informed electorate or you don't. And they don't. They think that if people knew this, they'd go crazy and spend. And my thoughts are, the evidence tells me exactly the opposite, that people would rather have 10% unemployment than 3% inflation. Okay. And they go overboard the other way. And I think there's a tendency to people to like having elevated rates of unemployment, 5, 6, 7%. The 93% who are employed can hire a plumber who come running out to do things because it's tough out there. They can get somebody mow the lawn. They can, oh yeah, I got here and I got my lawn mowed for $20. Oh really? I paid $30. Who'd you get it from? So I think that, and there's a lot of people who are very secure in their incomes and in their nominal wealth, and they don't like to see inflation, and they do like to see people coming to them for money, puts them in a position of power. And it's, at 5% inflation, unemployment, that's 95% of the people are on the other side of that trade. And it's human nature for them to like it. So you look at now where, the presidency gets turned over 3% inflation. Where'd that come out? It had nothing to do with people not wanting stuff for free or whatever, not wanting more government spending or services. They'd rather have, the inflation is what turned it over. Even with a strong economy and record low unemployment, we saw a turnover in administration. So I think that tells us something. Now, it might not always be that way, but it sure is there right now.
But I want to try to understand how MMT distinguishes between different kinds of government spending, because I think one of the things that made MMT prominent over the last several years, and correct me if I'm wrong, is that people were afraid that quantitative easing that began in 2009 would create inflation. And I think it was Milton Friedman that coined the difference here between high-powered money, which is money in our pockets, and it's actual money that fiscal spending would spend into the economy, versus financial money, which is the money that quantitative easing spent, quote unquote, into the system to salvage the health of the bank. So how does MMT account between the two? And do you see the high-powered money, the more fiscal aspects of money being the drivers of inflation versus monetary policy operations like quantitative easing?
Let me first say high-powered money is a throwback to a fixed exchange rate. That was dollars that were convertible to gold. That was the convertible currency was the high-powered stuff. And banks needed it. They couldn't because if people took their money out, they had to give them convertible currency. So the whole system was constrained by the quantity of convertible currency, which came from the gold reserves, and and doing that. Um, so in that light, if you look at quantitative easing, it's the government's buying government securities, and government securities are just dollars in safe, but are functionally savings accounts at the Federal Reserve Bank. So that's like if Bank of America or JP Morgan went to all their savings depositors and said, look, we'd rather have you in checking accounts than savings accounts. We're going to give you a premium of 0.5% or something if you'll, I want to go in and buy your savings account. Will you sell me your savings account and I'll credit your checking account with the money? We'll shift it from savings to checking. And you have a certain number of people with maybe $1 billion who said, okay, yeah, I'll do that. And so they had savings checking accounts instead of savings accounts. Would anybody have gone around saying, oh, that's inflationary? No. Okay. So, the Treasury securities are just $36 trillion in what amount to as savings accounts at the Federal Reserve Bank. It's a bank just like any other bank. It's a ledger. When the government spends, they instruct their bank to credit the account of your bank, okay, at their bank. So the Federal Reserve credits JP Morgan's account at the Fed. It's called a reserve account. It's a Federal Reserve Bank. It's a checking account. It's a transaction account. It's overnight money. And those funds are there. And they can't go anywhere except to somebody else's reserve account. And when they sell Treasury securities and you buy them, they shift those dollars from JP Morgan's reserve account to your securities account, which is another account at the Fed. And you still have the money. You had dollars in a JP Morgan account. You now have dollars in a savings account at the Fed. Your wealth hasn't changed. Nothing's changed. You do it at market levels where you could do it anyway. You really don't care who is selling you those securities. You can buy securities anytime you want, but price goes up a basis point, basis point lower in yield, and suddenly people want to buy that thing. That's what the Fed does. It's an auction process. And so they just change the indifference levels of holding it. And that's the difference between at the margin, the economy's desire to hold cash, to hold duration. They give you a basis point lower and you're less likely to hold duration at the macro level. And so people are holding reserves instead of securities accounts. It's not more than a basis point or two. It's not a whole lot at the margin. And so why would that change anything? So I had this conversation with a guy at the Bank of England, Andrew Crockett. I was over there maybe 25 years ago. And we were there with someone from the Bank of Japan. They had just announced quantitative easing. We're having a friendly, just three of us chatting. I said to the officer of the Bank of Japan, I said, why would you think it's going to matter if you go out and buy JGBs? You buy them from the bank, you credit their reserve account so the bank has fewer JGBs and more reserves. So it's not like there's a line of creditworthy borrowers just waiting for you to have loans. Loans create deposits. It's got nothing to do with the lending side of the bank. Why would you expect this to do anything? And Crockett looks at him and goes, yeah, what do you say to that? So he knew it wasn't a surprise to him. And the guy says, well, that's our policy. We'll just have to wait and see what happens. Well, after 30 years of buying every JGB out there and shifting maybe the entire duration of Japanese, what's called public debt to zero duration, it didn't make any difference, right? Like, why would it? The burden of proof to me is on somebody to explain why you think it would do it, not me to explain why it won't do anything. To me,
well, it made a difference in the sense that the Japanese government bond market ceased to exist essentially for a while, right? You went sometimes for days without any trading in Japanese government bonds. And
but so what? It's not like somebody wanted to trade and couldn't do it. Nobody wanted to trade. It doesn't exist overnight when people are sleeping. Well, you wake somebody up, you wake them up, it'll trade.
Well, do you think that a well-functioning sovereign bond market is an essential component for any country to function well? Is that a requirement?
I guess you could define a well-functioning economy that way, but I remember when there were no government bonds. Like, who cares? We use TEL 7 days or something as a benchmark, and it doesn't matter. It's just a reference point. You don't need a government bond market for anything. And I think Japan proves that. It doesn't have any effect on the macro economy if nobody trades JGBs. Who cares?
So what do you think would happen if the Fed were to buy so much or such a large percentage of outstanding treasuries that the treasury market, as it stands today, ceased to function, ceased to have the liquidity that it has? Would that have any implications for the U.S. economy, for U.S. markets, for the U.S. government?
I don't see it. I go one step further. Suppose the Treasury just shifted to all 3-month bills, and then there weren't any bonds. Like, so who cares? Save that step in between. Why does the Treasury have to issue them and the Fed buy them? It's kind of a waste of human endeavor with a broker or two in between. So just have the. So I met with Chairman Bernanke when he was in between being vice chair for 4 years and then chairman. He was head of the Council of Economic Advisors, I think. There were just 4 of us, and I wasn't here to talk about modern monetary theory because I wanted to get invited back, of course. But he made this. I asked a question. He had just been talking about unconventional monetary policy, and he had written something with Vince Reinhardt, who was head of monetary affairs for Greenspan and then Bernanke, who helped me write some of my speeches, by the way. When you talk to these operations guys at the Fed, they know exactly what I'm saying. That's their language. And you don't have to, you never discuss it. It's always the starting point. It's just assumed. And, but anyway, and I said to him, I said, I guess he wasn't chairman. He was chairman of the Council of Advisors. I said, you've been writing about unconventional monetary policy where the Fed might buy Treasury securities. I said, since the Treasury buying securities from the Fed is functionally the same for the private sector as the Treasury never issuing them to begin with. Okay. And so rather than issuing them and selling to the Fed, having the Fed credit the accounts, have you ever just thought about, coordinating between the Fed and the Treasury and just have the Treasury stop issuing those bonds? And he said, well, no, it is different. When we buy from the Treasury, we add reserves to the system. That has an effect. So it's like, okay, I didn't want to answer the question, but clearly he didn't understand reserve accounting because it was just, nonsensical answer. And he was a nice guy and a smart guy, but he's like a B student who'd studied real hard, gotten A's, and he was a professor from Princeton, and his specialty was the gold standard, the Depression in 1930, and what caused it. And everything he says is exactly right. And everything he did, to my original point, was echoing these gold standard things, like that adds more convertible currency under a gold standard. Okay, but it doesn't do that under floating exchange rates. Reserves, the holder of reserves has one option or two options: do nothing, hold reserves. I guess you could spend them. Somebody else holds the reserves, or he can buy Treasury security and shift to a different account at the Fed. On the gold standard, he has another option. He can take gold. That option's gone. And when you're not competing with that option, the entire dynamics of the monetary system is different. It's like you're watching a different channel on the television set. One program doesn't relate to the other. You can carry the language over, but it's a different program. They're different people doing different things.
So, just to sort of pull a little bit further into the reserve accounting.
Yeah.
So in QE, effectively, the Fed moves money from the securities account into the checking account, or the checking account into the securities account.
Okay, so they go out and buy
reserve account. Yeah,
and they don't go directly; they go through one of the primary dealers, and somebody sells that primary dealer securities, right? Now, let's say I sell them. Like, I don't know, it's the Fed buying. It might be Bank of America buying to add to their portfolio.
Right.
It makes no difference to the economy. If Citibank went out and bought all these bonds, would it change anything? No. So anyway, the Fed goes out and buys these things from me. I happen to have, let's say I am JP Morgan and I have a securities, I own Treasury securities. They don't own a lot of them, but they own a few. And I sell it to the Fed. And so I had dollars in my securities account. The Fed pays me by crediting my reserve account. And the Fed debits my securities account. So they debit the securities account, credit to reserve account.
Right.
That's it. Debit 10 billion, credit 10 billion. Yeah.
Right. So I guess my question is, under Basel II or bank capitalization regulations, is there a difference to the bank in terms of its capital flexibility or, ability to loan or what have you, between having $1 billion in the securities account or $1 billion in the reserve account?
Yeah, because the longer If it's a 3-month bill, no, because the treasuries are all zero risk weight, and and so are reserves. So there's no difference there. If you're in a long duration, uh, as a commercial bank under CAMELS regulation, it's CAMELS, so it's capital assets, management, E is earnings, L is liquidity, and S is interest rate sensitivity. So you are not allowed to have interest rate sensitivity. And they run you through tests. If rates go up, go down, they want to make sure your capital, for all practical purposes, does change. And if it does, you're supposed to make adjustments. So you're duration neutral. So basically, banks are supposed to be zero duration. So if you have long securities and you go to short securities, you've changed your duration, and that may throw off your balance. And if that's the case, you have to make that adjustment. So, but otherwise, the securities are zero risk weight. So it all depends on that. You also have like leverage ratios, and it might affect your leverage ratios. And that's your total assets versus your capital. But that doesn't change your total assets. So I would say that particular thing only changes your interest rate sensitivity, your duration of your bank. For an individual, it doesn't change.
Yeah, I guess my point is that if you're the bank and you've got a target duration, right? You want to hold a target duration for your portfolio. The Fed has just absorbed some of your duration. Will the bank then not go out and?
Yes and no, because you don't have to sell to the Fed. They just, if they don't get anything, they'll pay a half a basis point more and get it from somebody else.
Right.
5 basis points more, whatever it is. And they can affect the curve on that. I mean, if you buy enough at any point in the curve, the further out you go, the more likely you are to, the value of what we used to call pop, I don't know if you call it now, is a lot larger. The value of an 01 is a lot larger, a lot more bonds as you go further out. And so the Fed buying, 20 billion long bonds has more effect than buying 20 billion 3-month bills.
Right.
Okay. And so if they go up the curve and buy long bonds, they can move that market 4 or 5, maybe 10 basis points if they bought enough, maybe a 0.5%. But in the scheme of things, if you talk to the guy in the street about major problems in the U.S., you say, well, 30-year interest rates have gone from, 425 to 475. He'll look at you like, what? That's our biggest problem. It's like, who cares, right? 0.5%. But if you're in the middle of trading, it's a big deal. So I'm not, it depends on who you're looking at. But I think when they started issuing 20 years, which were a lot at the time, they put a dent in the yield curve of maybe 15 basis points initially before it's sorted out. Now that falls under fixed exchange rates, they used to call liquidity preference, which says there's always enough money to buy the long end, but there aren't necessarily enough people who want them at that duration. So the question is, what's the bid for duration out there? And the biggest surprise, one of my biggest surprises that I look at, because I never know how large the duration bid is how large that bid is. Over the years, I've seen all these panic situations. The Fed's going to do QT, sell long bonds. This is going to happen. That the long bond sells off, and it's like this is going to get up to 10%. They're not going to be able to sell it. They're going to have failed auctions. And all of a sudden, it rallies like 100 basis points, and it's like lower than it was before because of that bid for duration. So where is that coming from? Well, I can only look at the data and guess, but you've got pension funds who buy long bonds because it's Tuesday, right? They look at their balances, and on Tuesday, whatever came in, they buy it because they've got a 60-40 mix or some nonsense. And, that money just comes flooding in because every teacher puts $40 a week into a pension fund, and the teacher's retirement fund buys long bonds. And so, and somebody needs duration out there. And I can't tell you where it all is, but the bid is, how does the long get negative? How long have we seen this long curve? How does that happen without a huge bid for duration, right? So there's a massive bid for duration out there. And it's part of the institutional structure. Somebody's buying it. Insurance companies have to buy it to match something. Somebody's buying it to match long-term liabilities. There's a lot more long-term liability out there than we estimate. And then I estimate it always like, wow, that long and rallied 100 basis points. Like nobody had any idea who's buying. Yeah.
We've seen in the last several months now this conversation shifting about the U.S. government solvency and a possible debt crisis, and the fact that the propensity to own U.S. government bonds would decrease as inflation expectations would rise, not to mention the weaponization of the dollar and the appetite for foreign central banks to hold. You don't seem to be concerned with any of those factors. I'm trying to understand.
Look, if I was in charge, I'd be even less concerned because I'd only issue 3-month bills. I'd have the Fed set the rate at 0 like we had for 10 years permanently. They didn't have to worry about any of that. Okay. But yes, right now, they worry about their own problems they created and feel they have to continue to create. But even then, where is the 10-year now? Like 4.60 or something? Okay, that's that's at the Fed funds rate. That's a flat yield curve. How bad can it be if it's 10 years flat? It's not like it's even positive.
Well, the Fed funds rate is now closer to 3.5. So granted,
no. It's like 4.25, 4.5, right? Well, we had three cuts from 5.25 to 3 or 4.
Yeah, it's slightly positive now, but either way, it's not. It's basically flat.
10 basis points. Where's the 30-year? Now, the other thing is, you get positive convexity as you go further out.
Mm-hmm.
And so the convexity adjusted spread on the 30-year is wider than the nominal yields by quite a bit. And, I used to do very, very well when people would sell off the long end and not pay any attention to convexity, or the people doing it aren't sensitive to it. And the people who are sensitive to convexity are a minority, as we were. And you'd have these wonderful opportunities to buy things against the long end, have huge positively convex portfolios, and make a lot of relative value, out of alpha over time. And so that's another place where the bid for duration comes in because of all the positive convexity at the long end. That is, not something the average person who reads the Wall Street Journal or watches the news thinks about, or even the average.
Yeah, we think about that a lot for sure.
Yeah. So what's it worth? 30 basis points of positive convexity at the long end now. So what's a zero?
So what
coupon?
are the practical limitations for the government? Forget that the zeitgeist hasn't gotten quite there yet, and the Overton window. These ideas haven't quite fully been established in the Overton. What are the practical limitations? Is there an upper limit to debt to GDP?
So there's two things. The limit to what can be spent is what is offered for sale, and what is offered for sale is a function. Yeah, it's a function of tax liabilities. So you can't buy anything now with Confederate dollars because there's nothing offered for sale. But if somebody put in a tax payable Confederate dollars, now there'd be things for sale. People need the dollars to pay the tax. And it's a simple case of a monopoly. They've got what you need. They set the price level and they tell you what it's worth. So, so the limit is what the tax liability the need create. That's the nominal limit created by the tax liability. If you just give people money like Social Security, and now they become agents of the government, and so the limit to what they can buy, you have to consider not just the government, but plus its agents who are getting money. They're not selling anything to the government; they're just getting dollars. If you exceed what is available for them to buy, and they start paying higher prices, they are redefining the currency downward by paying those higher prices. And we call that inflation. I call it one-time adjustments in the price level. It's always a series of one-time adjustments. It's like quantum. It's not, time doesn't move smoothly. It moves in quantum measures. Quanta. So it's the same thing here. It's one purchase at a time. It's redefining the currency. Now there's a lot of it, so it looks continuous, but it's not. That's what inflation would be properly academically defined. If the definition were followed according to how it's academically defined, would be something else, and it wouldn't be that. Now, what we call inflation, fine, but that's a different matter.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com Now back to the podcast.
So not to get off the point. So the limits are a couple of things. What's for sale, right? And that's evidenced by prices. We can look around and see what's for sale. And if those prices are going up, it means government and his agents are paying more than what's offered for sale at current prices, and so prices are going up. And a lot of that depends on the institutional structure that sort of builds a lot of that stuff in. And some of it's based on what you can casually call excess demand. But if you spend on a price rule, if I say I'm going to go down the street and I tell you to buy every house on that street, but don't pay more than $500,000, and they're all for sale at about between $450 and $550, you're going to buy some of them, but you're not going to drive up prices. If I tell you buy them all, I don't really care what it costs, then you're going to drop prices. So if you're spending on a quantity rule instead of a price rule, you get very different outcomes. So government spending policy is critical in determining the outcomes. It's not easy to follow, but if you don't understand it, you're never going to get it right, okay? But if you do understand it, you at least understand the problem and you can qualify your answer based on your understanding, so which they can't even do.
Well, is there a difference between what someone might call, direct transfers, for example, what happened during COVID?
Yes.
And what some might call investment, where the government is going out to tender to companies who are going to build roads and bridges and set up, childcare services, et cetera?
Right. So one is the spending power of government is being transferred to somebody else. And you got to hope they do the right thing. Otherwise, if you give them too much money and there's not enough for sale, they can cause prices to, the government, when it spends, goes through contracting. And if they think the price is too high, they don't have to pay it. Now, if they need it, like the military, they just go to the lowest bidder, and they go ahead and buy it anyway. And they will also drive prices up. If we're buying oil from Saudi Arabia at the margin, we have to pay the price or turn the lights off. So don't forget, at the start of this whole thing, Ukraine thing broke out, and Saudis raised their prices up to like 120 before it turned around and came down. And that is highly influential in what we call the inflation indicators, which is CPI, which is not, it's our politically determined inflation indicator. And I'm not arguing with if it's good or bad, right or wrong, but it's not the price level. Okay. And so that oil is a big factor in that. Most things, prices are derived from that, and right down to your food supply and everything else. And we had all those supply constraints at the same time. And we saw the same pattern of prices rising into the peak of oil, and then oil coming down after President Biden cut that deal with Saudi Arabia not to prosecute the journalists they killed, Khashoggi, and to make them a deal to get U.S. weapons and get them back from Russia. They left us to go to Russia for weaponry and things like that after President Trump had threatened them with those kinds of sanctions if they didn't raise the price of oil during COVID, because cut production by 2 million barrels a day, which they eventually did with Russia. They got Russia to participate. They raised the price. But he was the one who insisted, when the price was negative on the Board of Trade, but I think the physical price was about 30 or 40, that needed to be higher because it was ruining our oil industry. So this whole thing about how to get more U.S. oil output is simplistically based on higher prices. We're going to get higher. That's their method of more production, is get prices up. So now there's an incentive to produce. It's capitalism. So I interpret the idea that we want more drilling to mean we want higher prices, so more drilling makes sense. I don't know any other way they have in mind of getting more production. Maybe they've got something I don't know about, but some subsidy or something. But I think it means higher prices, because that's what they did last time around. Yeah.
So that would be an example of, in a technical sense, industrial policy, right? The government is spending. Yes. Okay.
Yes.
Okay.
It's all industrial policy, right? Once you have coercive taxation, that's a command economy. Now, whatever the government wants, you have to sell it, or we can't get the money to pay the tax. It will price whatever it wants, so the relative value is high enough so that we sell that stuff to the government. So we'll sell them planes and tanks, because the economy can get money doing that easier than making cars and buses and fertilizer or whatever. So they will outbid everybody for what they want, and it is a command economy. The rest of it's a market economy.
The economy that where the government is spending directly into it.
Yeah. Because you've never heard them not get what they want, right? They get what they
want. Going back to, I guess, it's sort of related to quantitative easing, but Secretary Yellen has been slowly but steadily reducing the duration of debt issuance, right? Do you think that this is motivated or informed by her in general, or her policy associates starting to sort of embrace the view that you've been articulating over the last few decades and recognizing that?
Yeah. So the thing is, do they have some kind of master plan to go to a zero rate policy? So they don't want to get stuck with all this duration. And is that what's actually Chairman Powell is doing? Is he coming up with excuses to lower rates because he knows that lower rates will lower inflation now that he's had it backwards, but he doesn't want to say he's had it backwards, but by lowering rates, the inflation indicators come down, so he's going down to zero. Is that what's behind them? So I guess there's an outside chance, but just from the people I've met, I think we'd be giving them too much credit to keep that secret like that and have a hidden agenda. The ones I've known, and there hasn't been a lot of them, I'm not saying I'm insider like that. It's just, I don't think so. I mean, for me, the level of competence I've run into at the highest levels of everything has always been severely disappointing. And have you seen the Jared Bernstein from Finding the Money, that clip where they ask him why the government's printing money and borrowing, and he just fumbles terribly for a minute and a half, and then they go to something else? Have you seen that?
I haven't.
It's embarrassing, but that's how they are. They just don't know. So that's why I call the book Innocent Frauds. You can, are they innocent or are they trying to perpetuate a fraud? It's almost like it's more insulting to say it's innocent. They don't understand it. But, and there might be some of them like that, but I don't think they do. Again, I can be wrong. Maybe they do. And they've read my book and I don't know.
I would be remiss if we didn't circle back to something you just said a moment ago, which is the idea that if we reduce interest rates, we would help reduce inflation. I mean, that flies in the face of, I guess, everything I learned in university, which maybe was all wrong, but I love it if you could explain that notion to me, because I think that's one of the more controversial things I've heard so far. And I am trying to keep an open mind, but that is definitely something that doesn't really square for me.
So my partner and I were talking about this not too long ago. Like back in the 80s when we were running fixed income, we were saying this, when they'd raise the Fed funds rate or Greenspan would raise the rate, we'd say, okay, watch, inflation is going to start creeping up now. He's going to take credit for having been a good forecaster when really he's causing this. So it's not something I've come to most recently. Okay. It's been a long time. Now, I had a conversation with Paul Krugman 7 years ago, when he and Stephanie Kelton were on Bloomberg going back and forth with written articles about MMT and the job guarantee. And I said to him, what's your problem with the job guarantee, with the deficit and job guarantee? He says, well, if deficit spending gets high enough for the job guarantee, then the Fed can't raise rates to fight inflation, because when you raise rates, the extra interest the Treasury is going to have to pay will add to deficit spending, and that'll cause inflation. So the Fed loses that tool. And I said, well, you know what? I agree with you, Paul, but I think we're already there. Now, our debt to GDP was only 35% held by the public. But I'd already started saying that since the early 80s when I first got into this stuff, saying that, noticing that it's already happened. Okay. And I said, so I agree with you, but I think we're already there. And so I don't think, he says, well, I don't think so. I think if we raise rates, we still have that tool to fight inflation. And we kind of ended We just agreed on that. And it wasn't even agreed to disagree. We both agreed that that's in the new Keynesian model. Then the question was whether or not we thought that the debt to GDP was high enough. Well, after COVID, the debt to GDP held by the public went from 35 to like 97 or so, maybe it went to 100. And I go, okay, well, this is like, I've seen it, the effect at 35. I'm pretty sure that it's 3 times the fiscal impact now than it was back then. And when the Fed started raising rates, I was the first one out there saying this is going to backfire. It doesn't work that way. Other forecasts of inflation, of unemployment going up, I said, it's wrong. Unemployment's going to go down, not up, because their deficit spending's going to go up. And it went up to 5-6%, of which 3 or 4% was interest rate. And that's what happened. Unemployment came down and it didn't go up. It went up because we had big immigration, so that number went up, but the jobs have always been there. And it's still always 4.2. And GDP, I said, it's going to be strong. And it's been gangbusters the whole time, 3-ish%. Everybody was forecasting flat to negative. You look at the old Fed forecast. They're all forecasting a zero propensity to spend interest income. That has to be in their model because it's the same new Keynesian model. Only with that assumption would they not be forecasting a strong economy. If they had a normal type of propensity to spend interest income as they had for other kinds of spending, they would have shown runaway GDP and all that. And inflation came down because oil came down, or inflation indicators came down. Oil came down, the supply shocks went out the way. But if you notice, it's leveled off. Core inflation has started going sideways, started creeping up, approaching the Fed funds rate, which has come down. So the target's a little bit low. Instead of 5.25, it's 4.5 or wherever it is. And if they bring it down, then it'll level off there, and that's not day to day. That's, year to year or whatever. That's longer term. And there's a lot of yeah, go ahead.
You've taken pains to distinguish between inflation indicators and an inflation or an inflation rate.
Yeah. Yeah.
Can you measure inflation in a way that's not using an inflation indicator? How would you?
I can, but nobody's using it, so it's kind of a waste of time.
Yeah.
Like,
how would you quantify it?
I look at right. So I try and define it in a way so it all fits into the same, theory or explanation or model. So it all fits the same model. So I see, the government has the dollars that we need to pay taxes, so it's price centered, just like monopoly, economics micro 101 tells you how monopoly works. That's very simple. And everything I see substantiates that. It all works through an institutional structure, which clouds it and everything, but it's still there. You can still see it happening, and it's still a consistent explanation. And as we see the price level changing, I see it as a series of one-time changes. And okay, they can call that inflation, and I have to go use the words, or else nobody's going to know what I'm talking about. But I can't. Every time I say, the series of one-time adjustments has now compounded to like equivalent of a 3.5% annual rate or something. I'll just say, okay, the inflation indicators are going up at 3.5 to.
So will the inflation indicators eventually converge on the actual rate of inflation, or are they destined to forever?
So to answer your question, I have to decide, what academically is the rate of inflation? Where did it come from and all that?
Right.
So academically, it's a continuous increase in the price level. So under fixed exchange rates, that would be a continuous increase in the gold supply, the reserves, because that's how you measure the inflation as a chain. The price level is measured by your gold reserves. And if you double the gold reserves, like San Francisco gold strike, government monetizes it, buys the gold, spends it, prices go up. You have an inflation, you have the value of gold. The relative value of gold is fixed at $35, whatever it was back then. It's decreasing now to the value of everything else because of the new supply. Straight supply, demand, quantity theory, it fits. There's nothing wrong with quantity theory on a gold standard. It actually fits very nicely. The reason everybody's proves that it's wrong is because we're on a floating exchange rate. Well, it's the wrong context. Of course it's wrong. It's got nothing that it's not supposed to be right, but it is right with fixed exchange rates. So inflation would have been a continuous depreciation of the currency, which would be continuous new gold supply coming online, or a devaluation, where you devalue gold continuously. So you get a change in relative value, either nominally or in real terms. And that would have been inflation under the gold standard. So what is it under floating exchange rates? Well, what we have in the gold standard is an interest rate set by market forces. And it's generally a positive curve because there's risk in holding gold. And the indifference levels of people holding paper versus gold, they want to get an interest rate, or they just as soon hold the gold because that's a risk-free asset. That's the top of the pyramid. There's no pyramid for floating exchange rates except government and other credit. But with gold, the pyramid is how far away are you from the gold? You got the gold in your pocket. You got the gold in a bank vault. You got the gold certificate from the government. You're getting further away. You hold a 30-year bond. Now you're getting pretty far away from the gold, right? And so you get this positive yield curve. And that interest rate implies a continuous rate of change of the price level because it's the price of gold going up. You look at the forwards, they're going to be going higher, right? Or lower, right? Discount, depending on what it is. Okay, so whatever gold is, that's the price level. So if you look at the forward prices, that's the price level. And so to translate the language to floating exchange rate, what is inflation? It's a continuous change in the price level. So when I look at the price level with floating exchange rate, it's different from the gold standard. So for example, when we had that gold strike, we fixed the price of gold at $35, all other prices go up. That's inflation. Today, if we have gold strike and the price of gold goes down, that's deflation because we're not fixing it. So the exact same event, exact same shift in relative values, one's inflation, one's deflation. So the different context. So we got to to be able to use the same words and have it mean something, we got to turn it around. So inflation, as a continuous change in the price level, I see that as forward pricing. So if you look at spot gold at 2,600 or whatever it is, forward gold, and you have a zero rate policy like Japan and yen, forward gold would be 2,600, translate to yen, whatever that is. And the yen, of course, forward would be different from the dollar, but that's how it's equated. That's how those 3 points meet. But in yen, gold prices are flat, whatever they are. I guess it would be 260,000 or so times 100, 2.6 million or something like that. So, but it's flat all the way up. Okay. And in the US, gold prices are, because we have rates at 4 or 5%, they're going continuously higher forward at a 4 or 5% rate, something like that, roughly.
So is gold funded at a substantially different rate forward than other assets are priced forward?
Well, it might be, but there's on a risk adjusted basis, they're all the same. They're all discounted by the risk-free rate, which is the treasury rate.
Right.
Okay. So the funding rate is let's say the SOFR curve, the euro dollars.
Exactly.
They're all pretty close, plus or minus a risk adjustment.
Okay.
Okay. So our storage costs, if the
Right.
high storage costs have changed it. So assuming no storage costs and no risk adjustment, then the yield curve. So, and what that rate is, it's the price of what you would have to pay for gold right now as an agent. What today's agents have to pay to buy for forward delivery. So if you want to buy gold a year from now, you have to pay a 5% premium. And it's fair value because the seller of gold wants a 5% premium. Otherwise, he can get the price today and put it in the bank at 5%, right? So 4.5%. So its indifference levels are 5% higher. So the term, I call that the term structure of prices. Okay. And the term structure of prices are the prices faced by today's agents. It was today's flat yield curve, 10 years at 460. You could say that the term structure of prices appreciates continuously, compounded at a 4.5% rate for 10 years. So I would say the rate of inflation over the next 10 years, academically defined as the term structure of prices, is 4.5%. Now, whether that means anything or not, that doesn't mean the spot price of gold is going to go up continuously or the price level is going to go up continuously. But it also doesn't mean that it's not. So here's a question for you. Do the forward prices that are much higher now, the price of what's 5%? compounded continuously for 10 years. So it's what, 70% higher or something, 80% higher. Does that influence where the spot price of gold is going to be 10 years from now? I think it does. People deciding to mine gold, know their costs, they know what they'll pay for people. Any kind of forward planning is done based on those rates. It probably does, but I don't have the hundreds of millions of dollars to hire PhDs like the Fed does to do that correlation. But you think it might be useful for them, since every time they change the rate, they're changing the term structure of prices. They're changing the academic definition of inflation, directly one-to-one.
So by implication, as long rates or whatever, as rates rise, as the term structure steepens, then the expectation would be that is in general, maybe over the long term, on average, an indicator of the expected price appreciation of the gold over that time period.
I'd say it's an influence.
Okay.
I don't know how strong an influence. And look, central banks own 35% of the world's gold. They decide to sell it, it's going down no matter what the forward price is. So things can change the relative value. But so when I see the inflation indicators gravitating towards the Fed funds rate over a 50-year period of time, there are plenty of resets in there. Every time there's a reset because of oil price shock or something, it starts doing it again. Every time there's a break, it starts doing it again. It makes me think, there might be something there that I don't have the resources to confirm or deny. But
that's kind of the best we can get to quantify the actual expected inflation rate.
Yeah, that's kind of the wind.
Of a fixed currency regime.
Yeah, that's kind of the gentle wind blowing behind the boat, that you have to sail against. And I've noticed that now part of it is because it's all deficit spending. So when you're deficit spending for interest, that's different than if they raise taxes to pay for it and we have balanced budget. Then I think everything's going to collapse. But when you're just deficit spending to pay interest, isn't that like a stock dividend for an equity or a split? A 5% stock split or something, or stock dividend? What does that do to the value of the stock? It goes down.
So would you classify
some natural demand for it?
Would you classify the owners of Treasury securities then, to the extent that they own those securities, are agents of the government?
I haven't done that, but I'd say when they start spending, I'd say that's the interest they get is, I guess you could. I guess it depends on what the further purpose of the analysis is. I don't know if I'd make the general case, because they're not doing anything. They're just sitting there with reserve balances at the Fed. So they're not acting as agent, doing anything. When they bought them, all they did was shift their duration of their Fed liabilities. So they didn't.
But to the extent the private sector is receiving income from these securities that could be spent.
Yeah. So they are agents in that sense, as getting dollars that the Fed didn't have to give them. And they're not selling anything. So to that extent, they become agents.
In a sense, it's agents, what the Fed, what the government did when it deposited funds directly in everybody's accounts during COVID.
Yeah.
Right.
Yeah. So it's like 1.2 trillion of stimulus checks. And the interesting thing is they only pay it to people who already have money, and it's proportional to how much you have. So what kind of Congress would actively vote to pay $1.2 trillion this coming year in money to people who already have money, in proportion that they are, to how much they already have, in order to fight inflation? I mean, what kind of an obscenely regressive, idiotic policy is that? Nobody who heard it that way and recognized it could possibly vote on it, I think, unless they somehow thought, I don't know, it just seems so far-fetched that anyone who was properly presented with it would actually do it. But that's what they're doing. That's what they've been doing for a long time. So you ask me, are they aware that that's what they were doing? Doing this could be more regressive plan. I mean, if Elon Musk and Donald Trump have a plan to help the high end, why do they want to raise? They couldn't pick anything.
I think this gets interestingly to one of the hearts of the matter, right? Which is that, so you've got this $1.2 trillion in, I don't know why my video just went out, but you've got this $1.2 trillion a year going out to asset owners, treasury owners. You could if you were to reset rates or have a very different structure to how the government is funded, you could take that $1.2 trillion and use it to invest in, bridges, nurses.
The first thing you can do is stop paying, right? That alone would stop the distributional aspect. Now, if you did that, the budget deficit would drop to, not the first day, but it would drop to 1 or 2% of GDP, which would probably cause a lot of slack, right? Fiscal unemployment. And now you could redeploy those resources into something more useful, right? And probably useful by almost anybody's, estimation. Certainly come up with a lot better ways to deploy 1.2 trillion. It's not that you need that money. It's, it's interesting when people talk about money moving and this money could do that. All it is debits and credits, right? So it's in this information age, it's just dots going on and off, on some computer screen or on the, pluses and zeros and ones on a computer until we get quantum, but it's still zeros and ones. And if anybody looks at their TV screen and they watch a football game, they see people moving across the screen. But there's nothing moving on that screen. You get very close. It's just dots going on and off. It's got the appearance of motion. Well, dollars don't move. It's just accounts going up and accounts going down. And there's, you don't need the energy from one dot to light up the next dot, or else a person can't move across the screen. That's a scorekeeper. The scorekeeper doesn't need revenue to be able to credit your account. They just credit it and debit their own account for accounting purposes. Accounting is just after the fact record keeping. They account for it. They keep records of it by making an entry, but it doesn't come from the account they debit. That's just when they credit your account, that's just an entry. So they know what they did. It's a record of what happened during the day. And so if you look at it, the government spends $7 trillion. What does it do? It credits reserve accounts of all the commercial banks, mostly on behalf of their clients. It then debits those accounts for $5 trillion. Taxes get paid, mostly client accounts. The remaining $2 trillion, by and large, decide to shift those dollars from reserve accounts to securities accounts. Okay, and so the $2 trillion winds up in Treasury securities. Now, formally, the $36 trillion is either cash reserves or Treasury securities. They're all Fed liabilities because the Fed controls the composition between those three places. And they do it reactively, generally, to what the economy needs. That's what they call offsetting operating factors, so that their interest rate targets are met. With the zero rate target, they just have to keep excess reserves and supply cash on demand. It's the simplest thing. You don't need interbank trading. You don't need anything else. You don't need any Treasury securities. All those people trading Treasuries can go out and cure cancer or do something useful. Right? And if you look at the real compliance costs for all these policies, how many people are doing things that are functionally digging a hole and filling it in for massive salaries, too often, right? And well earned, because it's a tough thing to do, but it doesn't need to happen. I think we're losing 25% to 30% of GDP in real compliance costs, people's time that would be spent otherwise. And if you look at that time being spent on, I'll just say public education, public health, and transportation, public transportation, just for three things, that enhances the standard of living for the lowest income earners the most. People at the top already have those three things. They're not going to get enhanced. And so what you've done is increase the real standard of living of that group, which might, whatever percent it is, by maybe 50%. So we're sitting on potentially a 50% increase in the real standard of living of the lowest 50% of income earners just by not squandering real compliance costs without taking anything from anybody. Just people who've been digging holes and filling it in are suddenly doing something useful to somebody. And it's not going to happen. It's getting worse. It's not getting better.
Well, and also you've got the reason why there's regulations and compliance is because some subset of actors are bad actors. And so,
right.
If you,
you need bank regulation, but you don't need them to lend against financial assets. Okay.
But given the way the system is structured today,
yeah,
that this is the part where I continue to struggle. Given where we are today with the system, I mean, if we were to take on some of the policy suggestions that you're making, the system would collapse as it stands.
Well, wait a minute. Let's look at the zero rate policy. We've already done that for 10 years. Nothing collapsed. Then we backed off. That was already changing the income distribution numbers and the Gini coefficient. They're already starting to change and moderate a little bit with the zero rate policy.
Wait, but zero rate policy created more income inequality, not less.
Not it. No, check the numbers. I mean, it's a narrative because asset prices went up. Both Japan, they didn't have any asset price problem with 30 years of it. And so those went up for other reasons. So so we did have asset.
Yeah, that is the, well, what do you think the difference is between how things evolved in most Western democracies and what happened in Japan? Because I'm with Richard that, most of my investing life, I have been either strongly or mostly of the opinion that very low rates accelerate asset bubbles. I mean, for real estate, it seemed clear, and the IMF just published a strong case for the elasticity response of real estate prices to interest rates. But I think it's less clear in other dimensions. But why haven't we seen that? Did we see that in Japan? We have seen it here.
So about 25 years ago, I was talking to a guy in Australia, a real estate guy. I'd been down there, and it must have been the late 90s. I was there in 87. Anyway, I said, how's the real estate market? He said, well, it's pretty strong right now. He said, mortgage rates are 17.5%. But I think if they put them up to 18, it's going to collapse. I said, okay, thanks. My next call, I talked to somebody in Japan. How's the real estate market? Well, it's still really slow. We're at 3.5%. I think if we take it down 3, it's going to get going. Look, we had a stronger housing market in the late 70s with 15% mortgage rates than we had here, even with 3.5. If you look at it, particularly per capita. I started off in 1973. I was at the Savings Bank. We'd had 2.6 million housing starts with 8% mortgage rates and only 200 million people. Okay, so that's almost double the population today, 340. And 2 million is an unsustainable bubble with lower rates. It's not, yes, the rates have some effect in the short term at the margin, but fundamentally, I don't think that's driving things.
But how do you think about the price of real estate versus medium income, which makes real estate completely unaffordable to the average citizen? How do you square that?
Okay, so we had this question you were going to ask me that you never did about
I know.
in the 1980s. How did that happen?
Yeah.
So look, there's an old principle of mainstream economics, just like the new Keynesians have it in their model, that rate increases are going to cause inflation. Now, when I asked Paul about that a couple of years ago, I said, it doesn't look like it's causing it. He goes, well, I never said that. No, I think rates are still going to bring inflation, still going to slow the economy down. He still was forecasting a collapse. Okay. Anyway, we have game theory, right? So if you look at the labor market, it's a disparity of power. People have to work to eat, which they have to work or they're in trouble. Even if you're the last guy to be hired, the fact that everybody else has a job doesn't help you if you don't get one. So you're not in a better bargaining position because everybody else has a job as an individual, the micro level. Yeah, business only hires if they feel like it that day. They decide to wait a week. They wait, nothing bad's going to happen. They have to like the return on equity. I'm not saying they don't have times where they have to hire people, but overall, it's a massive disparity of power. So elementary game theory will tell you that real wages will stagnate at some kind of subsistence level, which vary from society to society, and we have other support unless there's some kind of support for labor. And up until the early 80s, we had support through labor unions, which were pretty ugly way to do it, I think. You have to support it, and a large group of people was better off, but it's very uneven. And for whatever reason, the corruption in labor unions is staggering. I don't know why that happens, but it's something else. It doesn't have to be that way, but it is. And so I'm not against labor unions per se, but I'm certainly against what happened.
The corruption.
that was there, and that may or may not still be there. So anyway, so I don't want to get off in that argument. But in the 80s, it all fell apart with competition, international competition, Reagan breaking the oak unions and everything else. But it was largely, we had oligopoly everything. The automakers would get together, the unions would strike one, they'd agree on something to give raises in line with productivity, and the others would fall into line and just raise prices. And that was the path of least resistance for business. And business always follows the path of least resistance. They want to make money. It's pretty clear. And that went away with foreign competition. So the only reason labor had power was because business had power. If business doesn't have any pricing power, labor doesn't have any power. They'll just shut the firms down. There's nothing the firm can do about it. And they lose their leverage. And that went away. And predictably, those lines diverged, where the productivity line and the earnings line diverged. Now, part of that is that line, I don't think includes benefits. So you got to double check to make sure that benefits are in there. But even with that, it is, and if you look at the real standard of living, what's happened is, one wage earner, the husband typically, could earn enough at a medium factory job or at a supermarket job to support the wife and have 2 cars and a television set, and the kids went to school and they were dressed nice and had plenty to eat, went to college. And today, husband and wife working is struggling with that. And, at least on the surface is, in some ways worse off. And so you could call it a 50% decrease in the standard of living. 2 people have to do the job instead of 1. And the anxiety level now is much higher. And so our prescription drugs are a lot higher. And, everything else that goes with that. And if you look at all the miracles of the internet, what it's doing, and companies like Google and Facebook, they just replaced Madison Avenue. It's all just a big advertising agency thing. That's the real strength of that, which is, what it is. We're spending enormous amounts of energy on advertising. If you look at how much it's all consuming, and all the data centers and all the AI, what's it all for? Why are they doing this? To sell advertising, which is, what's making the system run. It's really interesting. If you banned internet advertising, all of a sudden our energy consumption, everything else goes way down. We've met all our goals for the next 100 years on emissions control. And what have we lost? All these people trying to sell us things.
So I want to pull on one of the threads there.
Back to the wages. So that comes from what you're talking about, what you're seeing, the people struggling. But a lot of it is from this disparity of power, where there's no longer any support. The minimum wage is only $7.50. We're not even doing that. At least that used to be sort of a little bit of minimum support. So if nobody recognizes that cause, then nobody recognizes the need for minimum support as an institutional necessity. And so it doesn't happen. And labor gets crushed and our disparities of income go up. Minimum wage in Australia is $20 or $30 an hour. So other people do things about this that we don't.
But is the job guarantee not a potential policy, like labor supported policy?
Yeah.
And would that not shift the power dynamics?
Not at $7.50 an hour. So the concept is that you have to do it from the bottom up because of this disparity of power. Once you understand that, yes. Now you can introduce everything from the bottom up. So now the job guarantee is $15 or $20 an hour because you want that to be the minimum wage. Everything will adjust, and you're going to keep fiscal policy tight enough so that there are people looking for the job guarantee job. If you don't, suddenly you have nobody in the job guarantee and you've got inflation going, okay, you failed. But if you keep fiscal policy tight enough so there are 1 or 2% of the people in the job guarantee, it's turning over regularly, and you're introducing other benefits. It comes with childcare, it comes with healthcare, it comes with whatever you want. Now everybody else has to provide those to be competitive. So you're using market forces to introduce benefits from the bottom up instead of the top down. And so if you want that as public policy, that's the way to do it. Now, a lot of people, like I started earlier, don't want to see that in public policy. They want to see somebody desperate so that they will come to cut their lawn for $20, or beg for their money. They want to see that happen. And they'll complain if it's not like that. Oh, I remember when I could call up a repairman and he was there in an hour. Those are the good old days. Yeah. 15% unemployment during the oil crisis or something. You had people showing up really quickly. So it depends on how selfish the person passing judgment on the economy is. Yeah.
Now, do these policies all apply to other sovereign nations that have control over their own currency, putting the EU aside because they're a
Yes,
monetary
yes,
union?
yes.
Do they apply, or is there something
They
special
apply.
about the U.S. as
They apply to the EMU, to the eurozone also, but at the level of the ECB and the European Parliament. They don't bounce checks. The European Parliament, ECB had their trillion euro day. When they spent that money, everybody looked the next day to see where it was, and they couldn't even find it in accounting. They're just crediting accounts, just like the Fed. So
well, they don't have a fiscal union. They don't have a fiscal union, right? So they have this Frankenstein system where there's a monetary union without a fiscal union, and so
yes and no. They have a rule. They have this policy where we'll do what it takes to prevent default, which means they can run any debt to GDP they want as long as the European Central Bank approves it and allows them to keep funding themselves. So they sort of have it. See, here the states have to run balanced budgets because they're, quote, presumed to be off on their own. So the central government runs the 100% deficit, 120 deficit. In Europe, the central government doesn't do it, so the states do it. Somewhere in the public sector, they have to do it, or else, this is what I missed back. That's where the net financial assets come from. Okay, the public debt, whether it's state level, guaranteed by the ECB, or at the federal level, here is the equity behind the entire credit structure. That's the net financial assets of the economy that are there to support credit. And it's in real terms. You need so much of that in real terms to support, an equity. Just like Apple needs so many dollars in real terms to have a cushion. And if you don't sustain that, then everything collapses. So in 1979, where the inflation rate was higher than the rate of deficit spending, you had like 12% inflation and 6% deficit spending. The real public debt was collapsing at 6% a year, which is crazy. The equity behind at the macro level, the credit structure collapsed, and we had the worst collapse we've had. One of the worst collapses we've had. 2008 was the same thing. We had the deficit down to 1%. We had inflation running at 5 or 6, and the real number might have been the inflation indicators. Oil had tripled, right? It went up to 150, 160. And so we had a total collapse in the real public debt, and the whole thing just collapsed. There was no equity, insufficient equity behind the credit structure to support it. We had a big credit expansion, and it just collapsed. Same thing in 2000. The real debt to deficit went down. We had another oil pop back then. And, you have a leveraged economy because of housing, Y2K, and everything else. Budget went into surplus, plus the inflation. So the real public debt was collapsing, and it's just everything caved in. And every single time we've had a cave, it's been the consequence of a collapse in the real public debt. 3 years ago, Fed's tightening, everybody sees a collapse. I go, what are you talking about? We've got a 6% increase in the real public debt. It's 3% real, 6% nominal. I said, show me one time in history where that's ever not led to strong growth. And nobody could come up with one, but they still didn't look at it. They thought this other thing, the high rate hikes, would be more powerful. It wasn't. They could have been right. I mean, I didn't know what was going to happen. I'm just looking at what I was looking at.
Yeah. Well, I know you said that you've got a dinner to go to, and
what
we're
time
at
is it? 5:30.
5:30 mark.
Thank you. I was having too much fun here.
Yeah, me too. And I wanted to save time to ask you if you have any sort of investment views or asset allocation views or what have you. The reality is you've given us a very detailed framework and explained it very well over the course of the discussion. Do you want to leave us with anything that might be non-consensus?
Yeah, it's not. This is not a market play, but the tips now at 30 years at 2.5%. Why is the government paying 2.5% over CPI when it sells bonds? What are you doing? If there is a spike in CPI, you're going to have to pay it, which will increase deficit spending. They won't raise tax to pay for it. And if it's large enough, that'll create more problems. You're going to have Argentina on your hands. It's like, that's how they all started, with this indexation nonsense and Mexico linking the peso, the Tesla bonos linking it to US dollar. and the Russian ruble, linking it to the US dollar. Things, you make promises you can't keep, and you get this, let's call it hyperinflation, which is an exaggeration, but, compounding inflation, unvirtuous cycle on the upside, and you can have a currency, an inflation that people would call hyperinflation, 10, 15, 20%, the currency collapse going down,
No
based
doubt.
on it. So why are you doing this? You're not doing it because you've already spent the money. It's just a reserve trade. The Fed will say, or something, well, it gives us information as to what the market's, what do you need that information for? It's like, this is nuts. Sell $1 billion or something. Don't sell, I think 10% of the public debt, approaching 10% is tips now. It's growing, right? So, and as an investor, not knowing anything, to be able to get a real return of 2.5%, it's the chicken's way out. You're not going to get that in anything else. You look at the Argentine stock market, it's gone up 77,000%, but in real terms, it's down 10, right? Whatever, down 5, over the last 10 years. So yes, the stock market will go up huge nominally if you get a big boom, but it will go up in real terms. I don't know.
Well, now they have Javier Milei cutting deficit and strengthening the currency, lowering inflation. The stock market is up. I'm originally from Brazil, so a lot of my skepticism around these policies are underpinned by being a child of the 80s, having lived through what was called hyperinflation back in Brazil back in those days. I am faced with some cognitive dissonance of my own in trying to embrace some of the ideas that you're espousing here today, but I appreciate you giving it a try.
Yeah. So I was in Argentina 2 years ago, met with the central bank. I forget the guy, there was a young guy. There were only a couple of us in. And I did a presentation on the peso, which is online. You can have the link if you want. And some I was saying. And inflation was 30 or 35, and the interest rate was 30 or something. I'm sorry, it's the other way around. Inflation was 30 or 35, and the interest rate was 40 or whatever. And the IMF was making them keep the interest rate above the inflation rate to have a real rate. And I was saying this is causing inflation. It's going up because of that from lower levels. And for the reasons we've talked about. Over there, it's worse because at 40% interest, which is where they are now, by the way, they've only come down to 40. They haven't come down to anything reasonable. They're looking at 15% of GDP in interest expense. That's a pretty high number. So anyway, I said, and he agreed, but they had the IMF deal, and there's nothing he could do. And he quoted the Sargent and Wallace thing from 1987. That's pretty much the same thing, the new Keynesian model, which is what Krugman said when I talked to him way back. So they agreed with this, but they weren't in a position to do anything. So since I left, inflation went to 40, so they went to 50, inflation went to 50, so they went to 60. They went all the way up to 200 before the chainsaw hit, right? And inflation did come down after they cut rates, or if it came down a little bit. And after they cut rates, it came down. So they cut rates to 40 or 35 or 40, depending on what rate you look at, and inflation somewhere around 35. I don't think they get much lower than that unless they keep bringing the rates down. Now, that report and the whole meeting was on the desk of the central bank, the head of it, and he understood it. There's no pushback, and with him or his staff, so it was in front of him. So maybe it did get through to somebody who's not doing anything. Now it doesn't have a job now. Maybe it got through to the people in power now. Maybe somehow it got passed along. I don't know. So I'll just leave you with that. So watch to see how much of that you think is attributable to the interest rate, how much to the cutting super kitchens, which is 0.5% of GDP or something, and how much is to just making a 25% cut in the deficit by cutting rates. The low-hanging fruit is cutting the interest rate. Whether they keep doing it or whether the correlation holds up, I don't know. But I'd say keep an eye on that.
Awesome. Wow. All right. We'll let you get to your dinner. Thank you very much.
Thanks
for your patience with us today.
And if you have any follow-up questions, just email or send them. Or if you want to do it again, let me know.
Phenomenal. Thank you very much. Enjoy your dinner.
Yeah,
okay.
Away. Okay.
I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.
All right.